A market headline flashes on a phone, creating a sense of urgency even when the information is unclear. The pressure to act swiftly turns investing into a contest of reflexes rather than a practice of careful judgment. This occurs because the future is uncertain, leading people to fill the void with persuasive narratives. When certainty is promised, individuals tend to overtrade, pursue trendy ideas, and overlook fundamental risk management. The impact of this behaviour is not just lost returns, but also years spent on preventable mistakes and emotional turmoil. Over time, the real issue becomes missing out on simple habits that could compound gains, because focus remains divided. Imagine an investor refreshing quotes throughout the day, then selling in panic and rebuying in relief. Meanwhile, another person continuously pays for advice and trades, even as fees quietly erode long-term outcomes. This discussion will explore proven habits to adopt, thinking in probabilities, demanding safety, and simplifying for sustained success. This video draws inspiration from Richer, Wiser, Happier by William Green, so subscribe for more actionable insights. A transformative strategy is cloning, which involves borrowing successful methods and applying them with discipline. Instead of striving for originality, the focus shifts to recognizing effective approaches and replicating them without ego. This mindset positively influences results because small advantages accumulate, while clever-sounding experiments often lead to errors and delays. Consistently replicating good habits fosters reliability, and this reliability can surpass occasional brilliance. A disciplined learner studies a master's record and then implements the same strategies in their own context. In contrast, someone seeking novelty might overlook core principles and end up repeating mistakes that others have already solved. This perspective supports a broader strategy of reverse engineering success and fine-tuning execution one step at a time. It also keeps the focus on behaviour rather than bold predictions, because results stem from consistent actions. Choose one investor or operator to deeply analyse and identify the key habits that influence each decision they make. Then adopt those habits for a month, track outcomes, and fine-tune the details while staying true to the core model. Emphasising rationality means making decisions based on facts, probabilities, and trade-offs rather than fleeting impulses and emotions. It begins with acknowledging uncertainty and then searching for advantages that enhance outcomes over time. This focus on risk management is crucial, as avoiding significant losses safeguards compounding. While one major setback can derail years of progress, it also minimises emotional missteps, since decisions improve when checked against evidence and historical data. A disciplined thinker steers clear of risky ventures without an edge and avoids gambling on concepts they don't fully understand. Conversely, another person depends on hope, disregards odds, and equates confidence with skill until reality teaches a harsh lesson. This methodology links investing to everyday life, where the same probabilistic reasoning can inform health and relationship decisions. It encourages humility as growth and understanding increase when we withhold judgment and prioritise questions over instant answers. Identify situations where an edge is missing, then establish criteria that prevent involvement in those unproductive scenarios. Implement a brief pause when emotions intensify and ask yourself what is known, what is assumed, and what is missing. The margin of safety means investing considerably less than a conservative value estimate, ensuring that errors do not lead to disaster. This strategy simplifies decision-making by concentrating on intrinsic value and price, rather than reacting to daily fluctuations and opinions. Mispricing creates opportunities because it allows for advantageous positions, while fair pricing offers minimal wiggle room for error or unexpected outcomes. This perspective discourages frantic activity, as the best actions arise when the odds are clearly in your favour, rather than simply being thrilling. An investor may hear concerning news from overseas, but they critically evaluate whether the actual value of a solid business has changed that day. In contrast, another investor may react to headlines impulsively and sell at a loss, even though the underlying business remains unchanged. This strategy aligns with the broader goal of stacking odds by only purchasing when the deal is exceptionally attractive. It fosters independence, as one learns to use market sentiment as a tool to leverage, rather than a directive to follow. Create a concise checklist for valuing a business, and require a significant discount before making any purchase. If this approach helps you tune out distractions and respond with calm, consider subscribing for more valuable decision-making tools like this. Patience is the ability to wait without restlessness until a unique opportunity presents itself with favourable odds and clear value. It involves resisting the impulse to trade frequently, since mere activity does not guarantee an advantage. Concentrated bets at opportune moments can be significantly more impactful than making hundreds of minor decisions. This strategy also preserves focus, as fewer decisions lead to reduced regret and diminish the temptation to chase short-term performance. A patient investor tends to avoid buying during euphoric markets and instead acts decisively when a market downturn reveals bargains. Conversely, another may feel pressured to take every opportunity, spreading their capital thin and increasing the chances of mistakes with each trade. This approach supports the larger thesis that wise investors choose their games carefully, avoiding unnecessary risks. It also instills humility, as waiting acknowledges the reality that good opportunities are rare and cannot be planned. Set alerts based on valuation ranges rather than price changes, allowing opportunities to arise without the need for constant searching. When a rare bargain appears, dive deep into research and then act decisively with a position size that reflects your confidence. Simplicity wins, as complexities, costs, and overconfidence quietly diminish long-term returns year after year. Keeping expenses low acts like reducing friction, with every saved percentage compounding over decades of investment. This principle impacts outcomes because fees and trading costs continuously erode returns, even when performance appears adequate. It encourages realistic expectations, as matching market performance can outperform many attempts to beat it. One savvy investor opts for broad index funds with minimal fees, steering clear of the costs associated with frequent trading. Another investor pays high fees to advisors and trades often, only to find that the gap in returns widens over time. This approach emphasizes the importance of reducing losses just as much as it highlights the value of finding winning opportunities. It aligns with the concept of disaster avoidance, as consistent growth coupled with survival can lead to remarkable success. Take the time to review all fees, expense ratios, and trading habits, then streamline your system to operate with minimal decision-making. Prioritizing durability is crucial, since the passage of time is unpredictable, and complacency about stability can undermine your efforts. Aim to create a life that genuinely improves over time, using clear thinking to sidestep avoidable mistakes. Better outcomes arise from accumulating small advantages, rather than attempting to foresee every change in a dynamic environment. Duplicating successful habits minimizes wasted effort, allowing you to adopt effective strategies rather than reinventing the wheel. Embracing rational decision-making contributes to a sense of calm, as recognizing probabilities improves choices while managing emotions. A margin of safety paired with patience is essential, since bargains are rare and demand a willingness to wait rather than rush into action. Keeping costs low and adhering to simple principles safeguards your returns, while focusing on disaster prevention sustains your compounding growth for decades. Start with one actionable item today. Either define a personal edge that sets you apart, or eliminate one recurring fee that contributes no real value. Next, establish an internal scorecard to track progress based on the quality of your processes instead of external distractions and validation. Approaching life with humility fosters adaptability, knowing that nobody can predict the future, or even truly understand what possibilities lie ahead. If this perspective resonates with you, consider subscribing for more practical frameworks that help you make steady, informed decisions.